Hi guys, this is Bezos and we are here to teach you what is income statement. And before we start, I will show you what is income statement looks like.
What is income statement? An income statement or profit and loss account is one of the financial statement of a company and show the company's revenue and expenses during a particular period. It indicates how the revenues are transformed into the net income or net profit.
Where do you use the income statement? There are three major of financial statements. They are balance sheet, cash flow statement, and our topic income statement, also known as profit and loss. It is a financial statement that shows you the company's income and expenditures. It also shows whether a company is making profit or loss for a given period. The income statement, along with balance sheet and cash flow statement, helps you understand the financial health of your business. Why is the income statement important? In the business world, the preparation of an income statement occurs regularly, quarterly, and even annually. Regardless of the size of an organization, preparing an income statement is a necessary undertaking for the following reasons. Number 1. Assist in making decisions. Reading the income statement provides business owners with an understanding of the company's present financial standing, with the precise numbers given on the income statement. Business leaders may make rapid and prudent judgments on the company's expenses. Number 2. Report for compliance. Operating a business in a country necessitates the payment of various sorts of business taxes in accordance with the country's tax legislation. Taxes and businesses are required by law. The income statement and other financial documents will be of great assistance in supplying the required financial data for calculating your tax liability. Tax the company's profitability. The income statement will provide the business owner, shareholders, and other stakeholders of the company's financial condition.
Understanding the income statement. When it comes to a company's financial health, an income statement is the one of the most important documents. The three main components of an income statement are revenue, expenses, and profit.
Revenue is the amount of gross income produced through sales of products or services. A simple way to solve for revenue is by multiplying the number of sales and the sales price or sales average service price. Expenses is the operational cost that is paid to earn business revenues. It means the outflow of cash in return for goods or services. Expenses can also be written as the sum of all the operations that usually bring profit. Examples of expenses include rent, utilities, wages, salaries, maintenance, depreciation, insurance, and the cost of goods sold. Profit is revenue minus expenses. Profit is the money you have left after paying business expenses.
Uses of an income statement. The basic function of an income statement is to convey the activities and profitability of a business. It delivers micro insight if designed for company departments.
On the basis of the income statement, managers and investors can determine the strategy for a certain product, department, or the overall company, while an annual income statement provides an indication of the annual plan to be established for the following year. Monthly and quarterly reports might facilitate a change in strategy over the near term.
On the basis of an income statement, crucial decisions can be made, such as boosting manufacturing capacity, pushing sales, targeting a new audience, or closing or launching a new department.
Research analysts utilize an income statement to compare a company's quarterly and annual performance. Investors can also determine whether the management has been able to control operating expenses without sacrificing efficiency.
Types of an income statement. Single-step income statement. It is a basic report of a company's profit prepared using a single equation to calculate net income. Net income is equals to open parentheses revenues plus gains close parentheses minus open parentheses expenses plus losses close parentheses. Multi-step income statement. It calculates the net income using a three-step process. It separates operational revenues and expenses from non-operational ones. Gross profit is equals to net sales minus cost of goods sold. Operating income is equals to gross profit minus operating expense. Net income is equals to operating income plus non-operating items.
Reading income statement. The aim of this standard format is to determine the net income applicable to common shares by calculating the profit or income at each subhead of revenue and other operational expenses, and then accounting for mandatory taxes, interest, and other non-recurring one-time occurrences. Despite the fact that computations require simple additions and subtractions, the sequence of the entries in the statement and the relationships sometimes become repetitive and complex.
How to make an income statement. Number 1. Reporting period. In order to prepare an income statement, we must first select a specified time period. Monthly, quarterly, or annual periods are all acceptable. Typically, publicly traded corporations prepare an annual income statement, whereas smaller businesses generate monthly or quarterly reports. Number 2. Trial balance report. After identifying the reporting period for your income statement, a trial balance report will be required. This report will provide you with the ending balance of each account as well as the necessary statistic for preparing an income statement. Number 3. Revenue. Now that you have the balance report, you must determine your total sales revenue. The total revenue will comprise all of your company's income, including payments that have not yet been collected. Totaling everything will yield for your revenue. Number 4. COGS. The cost of goods sold is determined by adding up direct labor, overhead expenses, and materials. Add the total cost of goods sold to your sheet. Number 5. Gross profit. Subtract the COGS from your revenue and you will have a gross profit figure. Number 6. Operating expense. Add all your operating expense costs mentioned in the balance report and enter it in your sheet. Number 7. Income before taxes. Subtract your selling and administrative expenses from gross profit to determine your income before taxes. Number 8. Net income. Subtract your gross profit with all expenses, including wages, taxes, and COGS. Net income is obtained after that.
Summary. A balance sheet, cash flow statement, and annual report with income statements assist in determining a business' future financial trajectory as well as its efficiency and worth. An income statement analysis can disclose if revenues are increasing, the cost of goods sold is down, or the return on equity is increasing. If you intend to invest in a business, evaluating its income statement will be one of the most important steps. Learning to read, comprehend, and construct an income statement enables you to make informed judgments about business or firms.